Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Oh, David, so much content to blast through today. I scribbled notes, as always, at our team meeting, and one note I have says the aborted coup in Russia means a longer war, and then also over in Europe, the Purchasing Managers Index is down. Two pieces of bad news for the world economy, David.
Yeah, we actually had, so we have what's PMI. Basically, this is how we measure services growth or contraction, and you can measure manufacturing goods and services. You can measure the service sector and the manufacturing. And on the manufacturing goods side, we're seeing accelerated. So not only are we seeing contraction worse than anticipated across the board, we're seeing acceleration in the deceleration. So in other words, it's nosediving, right? So Europe, we saw Germany do this, Norway do this, France do this. The whole Eurozone is basically nosediving on productivity and goods and services. And that's not really good, especially because they are still fighting very high inflation, much higher than we have over here. And again, yeah, we had the 6-hour coup or whatever it was that happened over a week ago weekend, and it was, we'll find out what really happened down the road. It was almost like this was this built out to find out who the traders were.
It's kind of a theater of the bizarre,
yeah,
wasn't it?
And because and I actually have I've got a friend that's very high up in the oil industry sent me a text. If this is real, you're going to see oil move 25% on Monday. Of course, it was not. It was over with before that happened.
Okay.
It was interesting to see. And then oil actually went the other way. But, yeah, just not good economic news in general. And then on top of that, as we talked about, you see inflation still reading higher around the globe than most people want to have. And so that's probably going to mean, more hawkish central banks around the world. In other words, still more tight policy, which is going to probably lead to more downturns in the economy.
Well, hawkish was the very term used by Mohammed El-Ari, and he is a financial commentator we've cited many times on this show. He sent out a tweet, David. The 50 basis point hike just announced by the Bank of England is more hawkish than the consensus expectation, a signal that the Bank of England is worried about the dynamics of price increases and, in particular, service sector inflation, notwithstanding its statements on the lagged effects of the prior 12 hikes. A setup for more rate hikes, and it is set up for more rate hikes despite 2 of the 9 Monetary Policy Committee members voting for a 25 basis point hike. David, sort all that out for us.
All right, so basically all of them are voting to hike, right? And the majority of them want them to go.
It's just a question of how much.
And this is what we call a surprise hike. So this wasn't telegraphed. Most central banks don't want to rock markets, so they kind of want to forecast through speeches and language what they're about to do, so that's kind of expected, at least, so you don't disrupt. But they had to do this on the fly. This is what we call a surprise hike. Didn't telegraph it, wasn't expected by the markets, and it shook the markets for a bit. And this is a little old now, a week old plus old now, but they're fighting inflation. Inflation in the UK is still 8.7% year over year, Chip. And again, we're all going into our third consecutive year now of these high inflations. So that means people are paying 25 and 30% more in some of these European countries for goods and services, just basic needs they were paying just a couple of years ago, and it's unsustainable. So, and it means also that, countries still have high inflation. That hurts us and will make our inflation sticky longer, et cetera, because they will export some of that inflation if we buy any of their goods and services.
Let's stay focused on Europe for a moment, David. There's a CNBC headline. This is actually a report from the Hong Kong and Shanghai Banking Corporation, HSBC. The headline is, a U.S. recession is coming this year, with Europe to follow in 2024. What do you think about that, David?
Well, I think it's obvious. I think that's true. And Joseph Little, I think his name is, who's their chief strategist or what have you for HSBC, is kind of forecasting this. And that's simply because the Federal Reserve, both here and the central banks abroad, are still in tightening mode and have further to go. And we've talked about that extensively. And they won't stop until they've created what we call demand destruction, right? They have to destroy the economy. It's the only way they can get inflation under control, because they don't have any other way to do it. Unfortunately, they don't understand economics, at least how I was trained. But anyway, so they're going to create these recessions now that The problem is how bad is it? And again, the longer they take, Chip, the deeper the cuts will be, right? If they just rip the Band-Aid off, which I've been talking about for 2 years now, they could create a really severe downdraft, but it would be a V-shaped recovery. Things would reset, and you could work your way out of it. We're looking like we're going to go into a prolonged period now, which is really not what we want to see. And again, all the data is pointing to more like a 1970 style stagflation recessionary period, where if you remember back, and you're old enough to remember, right? You weren't really spending the money economy when this was happening. But I mean, you were a young man, teenager, or well, a little older, maybe you were. Don't want to age you here, but anyway, it was a tough time. It was a very tough time in the American economy, and it was a prolonged tough time, and I don't want us to go there. So the longer they take, the more risk we have of a very prolonged down.
So was this a good move by the Bank of England? This 50
it was a
basis point
necessary
hike?
move.
A necessary
it's
move.
a good move, but
is the way to
it's
put
a
it.
necessary move. Yeah, you have to. Again, Paul Volcker was the guy that had the wherewithal to do this in the 80s after we tried raising interest rates somewhat aggressively like the Fed's been doing, but he just ripped the Band-Aid off and went to the moon, basically, and it was a very rough period. But what came after that was the best economic activity in the history of the U.S. And so, there's lessons to be learned, but it's not politically expedient today to just do what's necessary. You have to kind of try to bob and weave to survive.
One more out of Europe, David, and this is something I have heard you advocate ever since I've known you, going on 7 years now. The Red State headline is, Sweden shocks Europe, abandons unstable green energy agenda, returns to nuclear power.
Well, imagine this. They can't power their economy with solar and wind. It's impossible with the current technology. Now, I'm not saying this isn't possible at some day in the future, but this nonsense that we're going to mandate you go to some kind of power source that is not proven is ridiculous. And if you're really worried about the CO2 emissions, we've already developed a power that's clean. And after the CapEx spending, when you put it up, it's almost free. That's called nuclear power, Chip. And for some reason, we're decommissioning them. It's the safest power ever created. It's the cheapest form of power ever created. And for some reason, they're running away from it. Why, Chip? Because we wouldn't need to tax you if that was the power source we needed. So unfortunately, and this is why I challenge people. I have no problem if you care about the environment. I do, right? And so if we really are serious about trying to handle our emissions, we should use the fossil fuels we have for now to power ourselves through. And here's what's unique is the U.S., which we've been cutting back on, burns fossil fuels cleaner than anybody in history, right? It's our counterparts across the globe, Asia, India, that don't do anything to filter the carbons going out, et cetera. So we can do fossil fuel technology way cleaner than most of the world. We should be mandating them do that if we're going to do trade with them. And then two, let's wait for these technologies to be ready for prime time before we implement. But if your answer is to simply tax somebody to solve it, then you're not trying to solve the problem. You're just trying to get their money. And so that's my problem with the motion. But they're telling you, hey, we can't do it. We're walking away from the pack. Sorry. And you're going to see more of this.
Back here at home, David, Walgreens slashes earnings guidance due to lower consumer spending, drop in COVID care demand. That's a tough double whammy.
Well, yeah. So retail in general, and of course in the healthcare sector, which has been underwater this year, surprisingly, they're up against tough comps, right? So they had an influx of business during COVID because people were buying masks and getting shots and being more proactive and probably just buying in general vitamin C and vitamin D off the shelves inside the stores, right? So they were going there more often. Now they're up against those as their what we call comps, right? When you compare your earnings year over year, very, very difficult for a company to continue to beat. And we're going to see that problem all throughout retail the rest of this year because they're up against very difficult comps the last 2 years because retail was up. Now it's not. And Walgreens just sees the traffic dropping out the bottom here. And so they're forewarning of a recession. And this is a good indicator because, Chip, companies like Walgreens and CVS, they're pretty much staples of American society today, right? I actually, on the way into the studio this morning, was listening to a local DJ talk about experiences going into the pharmacy. It's somewhere we almost all visit on some occasion once a month. I know I'm in one of those stores at least probably once a month, and whether you're just picking up deodorant or a soda or a gallon of milk, they become a staple to society, and they're seeing their traffic drop off, and that is not a good foretelling thing. And I think you'll see more companies reporting ugliness in the coming weeks and months.
David, you sent me two charts. One of them shows corporate bonds, government bonds, and the S&P index converging at a point of just over 5% return. And the other one compares equities with GDP. What are the takeaways from these charts? We'll have those available for people on the YouTube channel.
Yeah, so Bloomberg put out a chart. It's pretty interesting. Basically, and it's kind of forecasting you may be losing the incentive to chase the equity market here because basically the yield on equities, and so this is basically the yield you're going to get on it right now is equal to that of a 3-month T-bill, which is about 5.3%. The federal, because where the Federal Reserve has interest rates between 5.25 as we record this, right? And if you look at the forward earnings of the S&P 500, that's what they're expected to do, about 5%. And guess what? Corporate bonds are yielding about 5%. So they're all yielding the exact same amount. Which one of those has no risk?
Well, yeah, you want the bonds, you want the government bonds.
Well, so the T-bills,
yeah.
so corporate bonds would be next safest, and then equities would be least safe. So in other words, if you're only expected to get about 5% growth going forward on stocks for the next year, that means your money would grow. Now obviously stocks can trade ahead or behind earnings, but in theory that would mean your stock would grow about 5%, right? If earnings grow, then that's what stocks would grow. So you have to risk your capital, which can go down, major amounts to get an expected return for the next 12 months of about 5%. Or you could buy a U.S. Treasury for the same time period and get a guaranteed interest rate backed by the full faith and credit of the U.S. government. So in other words, people may be losing their appetite for risk here, which means that could be a precursor that money, and guess what? The Treasury is going to be floating a lot of debt out here, as we've talked about in the month of June, over $1 trillion alone. So there's not only is going to be an appetite for it, they're trying to fill the coffers back up and fund all this crazy spending because we didn't stop the debt ceiling, and the debt ceiling has been raised, and we're adding $2 trillion in 12 months. And so that does not bode well for equities. In other words, because that cash is coming out of the system that would have chased equities, and then people may have less of a tolerance for risk based on those metrics. And then the other chart was just talking about how you can kind of, on a long-term chart, and we'll have that chart up for you, measure basically the where equities are, how far ahead they are of the growth of GDP, right? Because they get ahead and behind over time, and we've never had it this far. It's outpaced now the dot-com era. And so that chart I sent you shows you that at some point that has to revert to the mean. All these are foretelling, and it doesn't mean it'll happen next week, in the next 2 quarters, or next year, but at some point, we're going to have a day of reckoning, and it's going to revert to the mean. It's very similar to 98, 99, where we still ran for a little while, but boy, when it snapped pretty hard. And we want people to be cautious out there and understand what that could mean for the way their current portfolio is set up. And we have a risk assessment we can do for you complimentary. It's part of our report card.
402-369-7777. That's a complimentary report card. There's no charge. There's no obligation. We will review your entire financial situation. Maybe you're in good shape. Maybe you need to make some changes. Now's the time to find out, and we'll provide recommendations on where you might want to go from here. Complimentary report card, 402-369-7777. Up next, digital currency. It's not going away. You need to be informed about it. At Retire Smart, our go-to guy on digital currency is financial advisor Brad Starken. He joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Digital currency, cryptocurrency. What is the status of digital assets? We have someone on our team at Retire Smart with a wealth of experience in digital assets. David, please introduce our special guest.
Thank you, Chip. Yeah, so really excited to have on the show for the first time. So this is 2 weeks in a row we got first-timers here. But you're not a first-timer to our industry, Brad. You've been in this industry for a long time. So, folks, welcome Brad Starkin, one of our financial advisors, been on the team for coming up on almost a year now. But we've not yet had you on the show, so thank you for taking time to stop in the studio this week.
Absolutely. Thank you for having me.
So Brad is got a pretty good wealth of knowledge, and you started at 10, 12 years ago, something like that?
Yeah, I've been 12 years ago in the industry.
12 years in the industry, and you, of course, are not from Omaha originally. So let's just talk about how you got here, to Omaha and actually to Retire Smart a little bit.
Yeah, absolutely. So originally from Milwaukee, Wisconsin, so don't hold that against me being a Badger fan, but played college basketball at Wayne State, graduated there with a finance degree back in 2011, and that's where had the opportunity to meet my wife. We went back up to Milwaukee for roughly about 5 years, and 7 years ago, she said, time to go. So we've been in Omaha. It's been great. She's from Bennington, and yeah, we've been here, and we have almost a 3-year-old. She'll be 3-year-old daughter coming up in August. So
Very cool. Now, you actually worked because you worked in the retail side of finance. Worked for kind of one of the larger, which is called big box firms out there for a while. But when you moved to Omaha, you actually got to see the industry from the other side, is basically what they call like a wholesaler, right?
yep, absolutely. So I was an internal wholesaler over at Pacific Life for just over 3 years, where we sold annuities and mutual funds, and that was 2 advisors. And during that time frame, my partner and I, right during that 3 years, was close to about a $500 million mark. So really getting into the weeds. So a very, very strong investment background for sure.
Yeah. So, and then you had kind of decided you actually like to get in front of clients a little bit more, and you kind of went back onto the retail side and worked for, well, I'll just call it one of our competitors. But anyway, we were really blessed to have you. I actually had to have a headhunter go find you. So, but we were really excited to get you on board our team last year, and you've been a great mix to it. But you bring some unique knowledge. You and I both have studied and looked at like cryptocurrencies basically about since inception. And again, forewarning everybody, we do not use cryptocurrencies for our clients' portfolios. This is not something we recommend, and we're not making any recommendations now. Nothing has changed in that regard. But digital assets in general are coming down the pipe faster and faster, and with the evolution of technology, AI, and other things, this is something that we, as fiduciaries, feel we are obligated to pay attention to. And so Brad has actually got more experience than anybody on my team when it comes to understanding really just how these things work in general, right? So, and boy, when you meet Brad at one of our upcoming client events or any of the things we do, you can pepper him with questions. He'll be the really tall guy. All right, so you'll know who to find. But so let's just talk about in general. And actually, you got certified. There's a couple of different certifications that the regulatory bodies have now approved. You have it's a DACFP. Is that correct?
That's correct. So digital asset certificate for financial professionals. And long and short, it looks at, Bitcoin, digital assets, and in general, which I think is the most interesting part of it all, is just the blockchain technology overall. And I think that's where we're really heading towards.
Well, again, I've talked about that for years, even sometimes on this show, is that's the real game changer, the innovation. It's not necessarily that we have this miracle asset that you put money in or something, and look, it's worth more. Certainly, it's a store of value to a degree when you use these and I don't think they're currencies, but they're called digital currencies right now. They're, in my mind, they're not really currencies, but let's face it, it's the technology that runs behind them, how you transfer an asset down the chain, blockchain, right? And you have to have a key kind of on each side of the chain. So there's what we call a public key and a private key. So this can literally revolutionize supply chain management and the accounting that goes with it. I've talked about it before, like the big 3 automakers out of Detroit. Their accounting department, they all have those massive headquarters. They have floors and floors of stuff with cubicles of accountants that do nothing but accounts receivables and account payables to vendors. I think a Ford F-150, full disclosure, I drive one. An F-150, I believe, has over 8,000 vendors in parts and things and they have to get paid, right?
Yep.
And so if they could streamline the payment, so in other words, when you deliver the plastic mold for the seatbelt lock, if payment transfers with it, which is what this technology would do, right? So basically almost like scan it and the payment goes with the product along the supply chain through blockchain technology. That eliminates some need for accounting or what have you, or just
Absolutely.
man hours, right? So the innovation, I think, is pretty cool what's coming. So tell me where you think we're going, and our listeners are definitely going to hear what your opinion is. And again, it's just an opinion on kind of Fed now, right? So we're seeing the people worried about the digital dollar, and that's probably on its way, but it's not going to be taking hold like tomorrow. But let's just talk about digital assets in general, where you think we're going.
Yeah, so I definitely think it's kind of interesting where we're at right now, where there's really not a whole lot of regulation around everything, and that's what we're waiting on from the SEC. And
Well, geez, it's kind of interesting how we've seen some, like a bulldozer just hit a couple of these guys in the last 6 months that were running some of these exchanges. Now, these are not the currencies themselves, but we talked about it briefly last week. FTX went down 6 months ago. Binance just got kind of attacked, and Coinbase all got letters and basically charges from the SEC. So,
yeah.
and lo and behold, the largest asset in the manager in the world files for an actual spot price Bitcoin ETF, which nobody has approved yet, right?
Yeah. So ultimately, within the past month or a little bit more, the SEC went after Binance US as well as Coinbase, and those are the two largest exchanges that people from the US can actually legally buy cryptocurrency from, or digital assets, if you will. And so they're under lawsuit right now. And just lo and behold, within 3 weeks after that, BlackRock, manager over $9 trillion, just happens to file for a spot ETF. And you want to know what their track record is on ETFs?
It's pretty strong.
575-1.
So that means, so what he's saying is basically they have filed to create ETF investment products 576 times. They've only not gotten approved once, right? And the SEC said, no, we're not going to approve that product for what, I don't know what the one was. But so you're saying they wouldn't have filed this if they didn't think they were going to get it done.
I absolutely believe that. So, and it'll be interesting to see where, everything continues to go.
Well, what's interesting is that we're in a world of copycats, right? So I know Wisdom Tree already filed. A couple of other large ETF providers are filing because they figure they got the language right, BlackRock. So they're just copying kind of their prospectus. And okay, if that's the way we get through, then that's because we've had others try, the Winklevoss twins, and those are the guys that helped start Facebook allegedly or whatever. Way back in the day, they had one. So, but I think it's interesting that they kind of waited until the things were moved out of their way, the competitors, so to speak, and then they come forward. So now what's interesting too, and again, not making a recommendation because this stuff can move around, but since that news, Bitcoin had moved almost 20% or something.
Yeah, more. It went. It was close to a 25% run within a matter of 7 days, and that's just because you're seeing some of the institutional investors potentially come into the market. And there was another frame of reference that came available as well on the institutional side. So we're retail investors. That's what we're considered as just everyday people. But the real money is institutionally, and from that you have. It was EDX markets, and there's actually 4 coins that are available on that. It's going to be Bitcoin, Ethereum, Litecoin, and Bitcoin Cash. And that'll be available here, I think, within the next month or so. So that'll be also interesting because the whole space right now is right around $1.2 trillion. I mean, it's smaller than Apple, if you will. Right?
Yeah, it's small in a couple companies. There are a couple companies bigger than that. So, let's pivot for a moment here in some of the time we have left and just talk about basically, so digital assets. So we talked about cryptocurrencies. Those are used for store value when you're exchanging things down a supply chain or just parking dollars. They're going to come under scrutiny from regulation and taxation in all countries around the world. And so the dream that they would be outside of that, I think is not realistic long term because governments aren't going to allow the transactions to happen without them getting their share of the pie, so to speak. So we'll talk about that. But let's talk about now our dollar, the U.S. dollar. And the Federal Reserve's plan, and they've already laid a lot of this out, and they have basically what we call the CBDC, so it's central bank digital currency, right?
Yep.
So and so we will have the digital dollar, which technically they've already launched with 12 banks regionally in some test runs now. So where do you see that going? And then if you care to comment on Fed Now, which is the Federal Reserve's version of PayPal or Venmo or Zelle or Cash App or what have you, a digital currency payment system that they want to basically control.
Yeah, so the CBDC has been launched, and they're basically in the trial phases for that. And I don't know if that's going to continue to take hold, but I mean, just from ease of transactions, right? I personally have an iPhone, so and I know Android, you can do the same thing. Like, think how easy it is just from a tap to pay standpoint. Going to your gas stations, grocery stores. I know I use it all the time when I'm at Hy-Vee, Casey's. When I'm going to those places, I just tap to pay and I'm in and out. Well, I don't think we're that far off from using some sort of a digital payment. I guess my biggest concern is the code that'll be written behind the digital dollar. Like what's going to say that we can't just continue to make more and more and more, just like our economy and our administration right now just continues to print
kind of inflationary pressures could that create? Jeez.
Precisely. And I guess that's one of my major concerns is I'm just really interested in what is that coding behind it, and is there inflation built in? Is there a limited supply? That'll be the real interesting thing.
And that is one of the reasons that when you look at like Bitcoin, there's a finite amount, right? When we hit the magic number, that's it.
Yeah.
There'll be no more. And that's what makes that so different than all these other coins out there. And so, from the study I've done, and again, we're not making recommendations that you invest in these things, but it's important you understand where the digital space is going. Because listen, with innovation, there is good and evil, right? There with great power comes great responsibility. So think of the benefits if we did move to a digital currency. So I want to talk about the pros and cons real quick. To me, all the illegal money, the activity that happens in our system gets now tracked, where a drug dealer that has pallets of cash sitting in a warehouse, it could be wiped out, literally. I mean, so there's benefits to society, but the downside is, and we've seen this in Europe, there are social contracts to go with the digital currency. You know, Brad, I think you've eaten enough red meat for the month. We're going to kind of stop you from being able to spend your money. And these are very real fears Americans have. So you know, it's going to be interesting to see how this plays out. We're not making recommendations or predictions either way, but we are planning on actually having just a baseline education class this fall that Brad will actually be leading. And so I would just tell you, we're out of time today. If you would like to get on the waiting list for that class, I don't have a date yet. We got to get some stuff run through our compliance department for it, but we just love to educate you on what we see coming and why we track it and pay attention to it and what it could do with the valuation of dollars, assets, things like that. So, hey, Brad, listen, out of time. Thank you. This is intriguing. Thanks for stopping by the studio this week.
Absolutely. Thank you for having me.
Very good. All right, Chip, what do we got next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, we have another question from an employee at Methodist where the 401k system is changing. The question is, I work in the Methodist health system, and somebody said you talked about our situation on the radio. I didn't hear it. There's a change happening with our 401k system, and I'm not sure I understand everything about it. Can you help me sort it out?
Absolutely, and so I'd encourage you to take advantage of just so you know, taking advantage of one of those 15-minute phone calls with one of the advisors on our team just to answer your questions. But basically what's happened is your employer has changed vendors for your retirement package, okay? And so you have basically your retirement account there that would not allow you to do things like in-service withdrawals, and your new vendor will allow that. So before you start with the new vendor, which actually starts this weekend, you were given some paperwork. They gave you the opportunity. You could do things. Either you could roll it into the new plan, or you could take your dollars and go, take care of them yourself. You could roll them to an IRA or whatever is best for you. There's a lot of decisions that you need to cover here. Understand how those dollars will be taxed. Can you move them into an account without tax? Why would you maybe want to do that? Why would you maybe not want to do that? So you need to understand all the expenses, fees, et cetera, that would be involved in that decision one way or the other. And then you understand about the taxation, which is what I kind of talked about last week. Was there's an opportunity for a lot of Methodist employees to start being proactive in the tax plan because they were not allowed to have dollars in the Roth side of the aisle, so they couldn't do these conversions because they couldn't move their dollars. Well, now we have several clients that we've already worked with where we're able to roll over the balance in their traditional plan. Doesn't stop them from putting into the new vendor's plan, doesn't stop the company match or any of that, but we're now able to start doing conversions and fill their current tax brackets up. Why this is so important, Chip, is we only have 3 tax years left. This one, 23, 24, and 25 under current tax law. And then we know we have a hike coming in tax rates. So we're trying to help you understand you can mitigate or reduce your taxes, pretty much guaranteed. Now, the Congress can change it, so I can't say it's 100% guaranteed. But moving while the tax rates are lower will save you instead of withdrawing those at higher tax rates in the future. And we can explain all that to you and just take advantage of one of those 15-minute phone calls. But yes, if you work at Methodist, you're going to want to pay attention. You probably want to take advantage of that call.
David, the next question is about charitable giving. I saw an article in the Wall Street Journal that I think said a person can make a charitable donation from an IRA and it will generate an annual payout to the donor. Did I read that correctly?
Yes, you can. So basically now we have what's called gift annuities, and these used to be mainly reserved for large donors, and it would actually be a place like hospitals, like, somebody's done very well in life, they would give a gift annuity to the hospital, so give them a large charitable gift, and that would pay them income back for the rest of their life, hence the word term annuity. This is not an annuity from an insurance carrier. This is from the nonprofit, and that's why it would be a hospital museum would pay back income to you in the form of a monthly check. Other words, an annuity. And so what happens here is now with some changes in the Secure Act 2.0, you can donate up to $50,000 from your IRA to a gift annuity, and you can get a paycheck back on that, basically depending upon your age. And the older you are, the bigger the payout will be, obviously, because they're going to pay it for a shorter period of time. So older clients can get as high as a 9.7% fixed rate on that payout. Obviously, when you've gifted the money away, so you're not getting it back, but basically it's coming out of your IRA because it's a gift. You won't be taxed on the distribution, and then you can turn around and get income back. So in the article example, A lady took 25,000 out of her IRA to set up a gift annuity. Had a payout of 7%. So this reduced her 2023 RMD, or required minimum distribution, and she's going to get a small check every year, $1,750, as supplemental income for as long as she lives. And so depending upon your age, it would change, how much that would be, et cetera. This could be, if you're, if you're philanthropically inclined anyway, and you have more money than you're going to use, this could be a unique tool to get you a little supplemental income. So it could be a good break. We've used these for very large clients in the past, but there's some provisions now where smaller people can do it. Smaller accounts could do it as well.
That reminds me of something you often say in your presentations, David. Give to charitable causes. Be generous. That's great. But be smart about it. Make sure you're doing it in the most efficient way to maximize the benefit for you as well as the recipient of your generosity.
As you know, I'm always passionate about trying to help people be good stewards of their money, and that's what we're trying to do, is show you there's usually a lot of people give, and Omaha's a wonderful community of giving. We have Giving Tuesday, et cetera, but a lot of people don't get any benefits from that giving from the tax code. We just want to show you that usually there's a way you can, even if you don't itemize on your tax return, so we can show you there's ways to take advantage of those things.
Speaking of the tax code, David, the next question is about taxes. I saw a news story saying the Supreme Court will decide whether Congress can tax wealth. That didn't make sense. Congress has been taxing wealth since the Constitution was amended to allow the income tax. What's different about this proposal?
Well, so what's going on is basically they're trying to tax the value, not of a sale. They're trying to tax the creation of value, right? And so this is a very important case to watch, because basically this could open the door to actually taxing wealth. In other words, Chip, if you have an asset and it's worth bigger than a threshold, let's just say $10 million is our threshold, and your asset grows to $12 million. Well, there have been proposals, and Senator Warren, Elizabeth Warren, is amongst them, that want to tax the value of these assets. And this is a backdoor way they're trying to do this on a case. It was the case of Charles and Kathleen Moore, and they received a $14,000 tax bill, but it wasn't on income, right? And so the 16th Amendment is what allowed Congress the ability to levy tax on income.
Okay.
And, at least in my humble opinion, in reading the Constitution, I know you've read it multiple, right? That's the limitation is, and we have commerce clauses, et cetera. But taxing value or assets, it would open up a can of worms that I don't think you could shut back up, and that would be a scary
This
thing.
sounds like a species of the property tax then. What's the valuation? What's your home worth? Well, we're going to tax you based on that. Is this a similar dynamic here?
So anyway, we got to lay the groundwork here and watch out how this works out. And you're going to want to pay attention, because let's face it, we have a progressive tax system. We have a revenue shortage. So they're going to find creative ways to keep pushing the envelope and taxing the haves versus the have-nots. And again, it's not just tax the rich, because once they get something passed, it's very easy to move that threshold down. I'll give you another example that holds to that. Is called the alternative minimum tax. Chip, the alternative minimum tax was created literally to tax about 236 American families, very wealthy families, an additional tax, if you will. And basically, it's about a 2% a surtax on top of their additional tax typically. Before Trump's tax cuts, that tax reached down well over 1 million tax filers in 2017. So in other words, because it kept creeping down. Yeah. And so, and just so you know, if you own municipal bonds, right, certain municipal bonds, depending on your situation, you actually have to pay the AMT tax. So your municipal bond is not technically tax-free anymore. And so this is why it's very important people understand what they think they vote for or what they decide they want. Just understand what it really means and the outcome that it would prescribe for you. So if you have one of these questions or something else, take advantage. We've got 8 15-minute phone calls available for you this week. We'd love to get you signed up with one of our licensed advisors to answer your most pressing question.
So what you do is give us a call, 402-369-7777, and schedule a 15-minute block of time with one of our licensed financial advisors. And you can present questions on this. If you're a Methodist employee, we'd be glad to accommodate you. 402-369-7777. There's no charge. There's no obligation. We're just glad to provide the information for us, for you. So give us a call and schedule a 15-minute conference with one of our advisors. 402-369-7777. Up next, speaking of all these tax issues, are you in danger of being nitpicked by the IRS? That's NIIT, net investment income tax. We'll explain what's going on next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. NIT, David, net investment income tax. Here's the headline from the Wall Street Journal. The "you make a lot of money" tax hits more Americans.
Yeah.
What's happening?
So this was one of 21 different taxes that were actually part of the ACA, otherwise known as Obamacare. The
All right.
Health Care Act came in there. Obviously, they had to find ways to create revenue to pay for that massive bill. And so one of those was basically what's called the net investment tax. It's a 3.8% surtax on filers' income from sources they get, including income, interest, dividends, capital gains. So basically, once you go over a threshold, which is $200,000 for a single filer or $250,000 for a joint married filer, you now have to add on this 3.8 investment tax. So this is really important. So let's just say you have a rental property, Chip, and you sell it and you have a $100,000 capital gain, and normally you're a married couple making $180,000. And so in that scenario with standard deduction, that person would fall right on the edge of what's called the 22% tax bracket today. But because of that capital gain, on top of it, now they're going to go to the 24% tax bracket, okay, on their income. So they've increased the tax they have to pay on some of their income. And that capital gain would be 15% in that scenario. But then you have to add, once they go over 250,000, in that example, they'd be about 280. Right, if they had $100,000 gain on top of 180,
Yep.
so they had 280,000 between income and capital gains. Everything went over that threshold of 250 would be also have to pay a 3.8% net investment tax. So it's a sneaky tax that kind of creeps up on people, and that's what the accountant was talking about. Hey, it's just a you made too much money tax. Well, no, it's a tax in addition to the tax you've already been told you would pay on the way you earn that money, whether it was interest, dividends, earned income, or a capital gain. So again, this is where what I call unfair taxation, and it's hitting. And again, when this was put in, which was, I mean, we're 15 years ago, right? Basically, when this was proposed and Obamacare got passed almost a decade and a half ago. Now it's hitting millions of people, just like I talked about the AMT tax a minute ago. These taxes always seem to swim downstream because we haven't inflation adjust those numbers. The 200 is still 200. Well, I can tell you, $200,000 income is very different today than 15 years ago, Chip.
Right, exactly.
So,
yeah. So
why
it's
haven't
not,
we pushed that number to 500? You know,
it's not the super wealthy. There's a huge swath of people. You know, our
No.
current president keeps saying no one under $400,000 will be paying any additional taxes. But here's another case in which people well below that
I had to have
threshold
this
could
discussion.
get hit with this tax.
I had to have this discussion with a client in her 70s, a widow, who happens to have more than she'll ever spend, a little over $3.5 million in assets, and has about half of that in CDs. As you would imagine, somebody very conservative, is not spending money.
Sure.
So she has like 10 different banks. She lives in 2 different states. You know what I mean? So she just likes having the safety, and we're fine with her having it, right? But she had to pay net investment tax because her interest income pushed her over the threshold. And I'm trying to explain to her, between RMDs, she happens to has a pension from her deceased spouse. She happens to have a Social Security, and so those 3 alone push her well over $150,000 a year in income, and then all the interest she earns, let alone what her portfolio grows and dividends there, but just the interest income she's earning, which is quite large, it pushes her over that $200,000 limit, and she pays a net investment tax on about $50,000 to $70,000 every year. And she's like, well, that's not right. I'm like, well, right or wrong, it's the law. And so you need to make sure. And she actually asked, is there something we can do? And the answer is actually yes. There is some things we can show you to mitigate or reduce that tax or defer it if that was better. So we actually went through some of those solutions for her. But here's the key, folks. This is what I say all the time. You don't know what you don't know. And it's so true when it comes to the taxation code and how it applies to you in your situation. And the older you get, the less maneuverability most people think they have. And it is true to a degree, you get kind of boxed in. But there are strategies we can show you how to implement to mitigate, reduce, or eliminate potentially these nuisance taxes, sometimes as we call them. And unfortunately, those taxes now, she was at one point before she had to take her RMDs and had all this interest income, because interest has gone up, by the way, where the CDs were paying nothing 3 years ago, right? So she didn't have the problem. So the benefit of more interest is more tax. But now she also at one point was qualifying for a homestead exemption in her home state, which is not Nebraska. But anyway, so there's there's so many things you have to factor into how these layer in, and what we want to do is help you understand what the intended consequences of your decisions are, and the unintended consequences. Both are just as important.
David, you sent me a story from the Street website called The Winners of the New World, and I just plowed into it and started reading, and then I hit the name Alan Greenspan as the head of the Federal Reserve. I thought, what, did I step into the Wayback Machine? Well, I look back at the byline. It's from February of 2000. It's about financial commentator Jim Cramer and some of his picks in the year 2000. I guess it was a bit of a guilty pleasure here just to look back at this from 23 years ago.
Well, this was February of 2000, just before the dot-com bubble went pop, and Kramer was like, "It's a new millennium, it's a new day, it's a new year. You've got to own these 10 stocks," and he robustly claimed on TV. And we'll put the article up there for you, but the stocks. Well, let's just say they haven't really fared very well. Okay, so I only think 2 or 3 of the 10 are even in existence today.
Oh boy. Okay.
And most of them just disappeared and went away. So you can, it was a company called Ariba, Digital Island, Exodus, InfoSpace, Ink2Me, Mercury Interactive.
A lot of these names, I didn't even recognize the names.
Yeah, Veritas Software, and VeriSign are the two that I knew. And I remember some of the other ones from the dot-com days, but they were the high flyers that went up and went down and went away. And so the point being, look, Jim Cramer's been giving advice to a lot of people for a lot of time. A lot of people like him. We're not trying to pick on Jim or give one way or the other. The point is, if you're relying on a talking head on TV or something to make your strategy for your retirement, that could be a risky venture, right? And so right now, what this, it feels so similar now to about 99 in my humble opinion, because now AI is all the talk. And so Jim was you got to own these stocks for AI, and one of those actually was down really big this week. That's been the kind of the mainstay winner here in the most recent months. Again, we're not trying to make any recommendations one way or the other, so I won't even name that stock, but not hard to figure it out. So the point being here, have a prudent plan. Invest with the amount of risk and appetite you're comfortable with, and for the time horizon when you want to access those funds. Have a plan.
Well, speaking of have a plan and making proper strategies and being proactive, David, on a more serious note, this Fox business headline is Inside America's Retirement Income Crisis. We've got the largest number of Americans in history reaching age 65 next year. And David, it looks like too many are not prepared.
A good portion of them. Next year, we're anticipated. So just, for the last 7 years or so, we've had an average of about 10,800 people turning 65 a day. Just happens to be the peak of when the babies were born. Next year, that number goes over 12,000 a day on average. So it will be the peak baby boomer turning 65 years. So it's going to be the biggest stress on the services like Medicare that we've ever seen. You're going to have more people enroll than have ever done before in history. And they're ill prepared in general to pay their income. So basically, 51% of consumers right now, I can just tell you from the statistics highlighted here, between the ages of 45 and 75, feel they don't have anywhere near enough saved to last their lifetime. 32% have no confidence that they'll have enough money to actually cover their basic needs, let alone discretionary spending, etc. 44% of currently retired people have had to go back to work. Right, and so is your retirement plan? You're going to become the greeter at Walmart. Nothing's wrong with that, but I'm just. In fact, my father-in-law always said my plan is to be the starter at the golf course. I'll get free greens fees, And so here's the thing.
But as you say, work-life optional. That's the idea,
correct.
not mandatory.
And so the article, which is in Fox Business, going on to make sure you understand. I'm not a big proponent of buying guaranteed income, but it is available if you've not saved enough. So there are products out there that will pay you a guaranteed rate of return or a guaranteed piece of income in a trade-off for some of your dollars. And those are usually going to be some kind of an annuity contract. But before you'd buy a guaranteed income, that usually comes with a guaranteed fee. And so we're always cautious of that. But unfortunately, we have the majority of Americans, Chip, have not saved enough for retirement. So the moral of the story here is, look, start planning. Find out where you are. Even if you're behind, just putting it off, not looking, don't open the statements and mentality. Well, I just won't look and then I'll hope something happens. That's really not going to get you there. Be proactive. So even if and I've had to do this, Chip, I've sat in the conference room many times and somebody's like, I want to retire in 3 years. And they're 62 and they're telling me 65. And I'm like, I need you to work to 72. I just debate, or you you show me you can spend less than what you're spending, but we're just not going to sugarcoat it. We're going to tell you the actual numbers, and it's math, folks. Wouldn't you want to know where you stand? And so that's the power of the report card. We can actually build out an inflation-adjusted income plan and show you exactly what you would need to have at the future date and what the most likely probability is of creating success based on your current savings rate, et cetera. But if you hesitate, it could be a sad day when you wake up in the future and find out that, you are the one that has to go back to work. You're one of the 44%. And unfortunately, we can't help them all, Chip. We try, but there's going to be a lot of folks that going forward, this is the case because we've become a society of less self-responsibility, unfortunately, and you want to push and rely on others to handle it. And that's unsustainable, even if and there's people out there that want to just confiscate everything and go to more of a socialistic model. If you don't grow the pie, we all go down. and if you take away the incentive to grow, you won't get any.
Well, this is a great segue to one of the big events in the nation every year. We're about to celebrate the greatest birth of freedom the world has ever known, Independence Day. And right in the middle of all that was taxation, right? It was a big issue then. It's still a big issue now. That's why we offer that comprehensive tax planning guide. And then, of course, if you want a 15-minute phone conference, did you say we have 8 of those, David?
Yes,
I
sir.
think this week. That's 402-369-7777. Call in and schedule one. Or take the plunge and get the report card. Complimentary report card. 402-369-7777. David, bring us home.
God bless America. Have a happy 4th of July. We'll talk to you next week.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.